Okay. Hi, folks who are joining us. We're just going to take a second to let people enter into the room here. So we'll start in about 30 seconds. Okay, we'll go ahead and get started. I want to welcome everybody to our Economic Outlook and Policy webinar series put on by the Department of Agricultural, Environmental, and Development Economics at Ohio State University, or The Ohio State University, to better state it. This is a series that we've typically held in the springtime, and this year we're going year round. So we decided to go ahead and open it up and have some webinars in the fall and to continue them on into the spring. Most of the webinars that we hold in this series are webinars conducted by folks who are in our department. Every once in a while, we have guest speakers from outside the department. And of course, they're tuned especially to try to provide information on timely topics for people here in the state of Ohio and nationwide. And really, today's topic, there's probably nothing more timely than the issue of deglobalization and trade policy, or just trade policy in general. So we're excited here today to have with us Dr. Ian Sheldon, who's the Anderson's Chair in the Department of Agricultural, Environmental, and Development Economics at Ohio State University. He's an expert, a well-known global expert in trade policy, and we're really excited that he's here with us today and happy to hear from him on this particularly important topic. So, Ian, I'm going to turn it over to you. But one more thing, just for folks who are joining us, you're all muted. If you want to actually ask a question, there are two ways to do that. One way is to do it through the chat feature, and I'll make sure that's available for everybody. It might not be available yet, but I'll make it available for folks. But there's also the Q&A feature, so feel free at any time to put a question in the Q&A or to put a question in the chat. We'll probably hold those questions to the end, where Ian has agreed to leave plenty of time for a Q&A at the end. So go ahead and put those questions in there, and we'll happily talk about them towards the end of this. So without further ado, Ian, thanks for joining us and welcome.
Thanks very much, Brent, and welcome to everybody who's listening online. My presentation today is actually an updated version of a presentation that I gave last month down in Lexington, Kentucky, to the Farm Credit Mid-America board meeting. So this is somewhat updated, particularly with some new data on what might be the effect of tariffs of an incoming administration on the agricultural sector. So the title, I'm going to talk a little bit about, are we deglobalizing? My answer to that is actually no. In fact, most trade economists working in this area don't think we're deglobalizing. We're certainly not globalizing anymore, but we're not deglobalizing either. And then I'm going to talk about trade policy in the context of deglobalization. So we know, and I'm just going to talk about the bullet points first, and then I'll show you, I have some slides that relate to every one of these bullet points. So after the financial crisis, 2008, 2009, we know that the world entered a new period, and it was probably the end of what economists call hyperglobalization, which was a period that went from about the mid-1980s through to the mid-2000s, when we had very fast rates of growth in international trade, fast rates of growth of global value chains, fast rates of growth of foreign direct investment, and high rates of immigration. Since the financial crisis, we've actually seen a rather modest decline in trade share of world GDP. I'll show you a graphic of that in a minute. And when we look at global value chains growth as a proportion of global GDP, we've probably hit what the World Bank calls a technological limit of about 50%. Although I would say, and I have a slide to back this claim up, that intermediate goods trade, so value chains, are very much about trade, not necessarily in finished products, but in the inputs or the intermediate goods that go to make up those final products. And in fact, intermediate goods trade has actually increased post-pandemic, which is one of the arguments behind economists saying that we're probably not deglobalizing to the extent that maybe the popular media has suggested. We've seen no major decline either in investment in various countries or immigration between countries. So to use the language of The Economist magazine, and this has been picked up by quite a lot of trade economists writing in this area, the world economy is probably entering a period that we would better describe as slowbalization rather than deglobalization. And then the question still arises, are we seeing any evidence of reshoring that was predicted as we came out of the pandemic or even before the pandemic and after the financial crisis? So I'm just going to show you a series of slides that relate to most of these bullet points. So this first slide shows you world exports as a share of world GDP between just towards the end of the 19th century through to 2021. This is data put together by Douglas Irwin, who's a professor at Dartmouth College. They're on the East Coast. The red dotted line is pretty much what the World Bank has put together. And if you look at my pointer, you'll see that round about 1985, we had this incredibly fast rate of growth of exports as a share of world GDP, which has been described as a period of hyperglobalization. It followed the period of post-war recovery, which followed a period of deglobalization in the interwar period. And then if you go back to the almost the beginning of the 19th century, this is what economic historians call the first era of globalization, that ended really with the First World War, was intensified during the Great Depression and the trade war that we observed. And then we had the Second World War. But what's important is this period of hyperglobalization that has certainly slowed down, if not actually ended. Here's the trade data. The dark blue line, the solid blue line is the value of trade in trillions of dollars in 2018 prices. And you can see that there was a bit of a significant dip around the time of the financial crisis. Then we had another significant dip during the pandemic, but the rate of growth of trade has continued over this period between 1989 and more recently up to about 2021. As a percentage of global domestic world GDP, you can see it slowed down here during the financial crisis, and it's essentially leveled off. And that's why trade economists are saying that certainly when we look at trade, we appear to have entered a period not of deglobalization, but of slowbalization. If you look at global value chains as a percentage of global trade, you can see that it just about went above 50% in the early 2000s, and then it slowed down back down to 50% as we had the financial crisis. These data only go up to 2015. And this is another argument as to it. We're not going down to periods like this, but we do appear to be slowing down in terms of the expansion of global value chains. But a more recent study by Oxford Economics that came out very recently, it was actually cited in the New York Times. This is a measure as an index of trade in intermediate goods. So these are the goods that are typically being traded in value chains. So these would be parts of automobiles, crossing borders, being put into a final good and then exported back or to other countries. You see that it fell as we went into the pandemic, but post-pandemic, we've actually seen a growth in intermediate goods trade, which sort of goes against the argument that we're seeing lots of reshoring and lots of nearshoring. It doesn't appear to be the case. If we look at inbound foreign direct investment, you can see that we've not seen any significant slowdown for the rest of the world. United States, investment in the United States as a percentage of GDP hasn't slowed down. The rates of growth in Germany are more modest, but we don't see any particular slowdown. India, the fastest growing economy in the world, is still seeing positive rates of growth in inbound foreign direct investment. Not much change in China. If we look at immigration, so remember globalization is measured in terms of trade in goods, foreign direct investment movement of people. You can see Germany's seen a significant increase in immigrants as a proportion of its population. I think that's partly driven by the Angela Merkel regime allowing in immigrants, particularly from the Middle East, North Africa, and other parts of the world where there is civil war, and people are just, coming through Italy and then they're moving up into Northern Europe. China, of course, you don't see much inbound immigration either to India or China, but essentially large developed economies like the US and Germany. One reason immigration is of political importance is that this is putting pressure on public services, et cetera, et cetera. Now let's talk a little bit about has the US decoupled from China? We know that global value chains were definitely under stress in the post-pandemic period and during the pandemic. But Oxford Economics, in their very recent report that just came out about a month ago, and those were the data that I just showed you for intermediate trade, there's been very little evidence of large-scale reshoring or nearshoring or even friendshoring. Those terms tend to be used interchangeably, certainly in the popular media. But interestingly, if we look at data from the Brookings Institute for US firms, they've mostly held on to relationships with outside foreign suppliers after the pandemic. So if you look at this graphic, this was published in the Brookings Institution papers by a couple of economists. The pandemic starts here. That's what the vertical bold line is. This is the percentage of importing firms. This is the value of US firms' relations with international suppliers. You can see the entry rate of foreign suppliers actually increased initially, then declined, and then increased again, declined. The blue line is the separation rate. So you can see actually during the pandemic, the separation rate was going down, the entry rate was going up. Separation rate has increased somewhat since the middle of 2021, but right now, more firms are entering relationships with United States firms as international suppliers as are leaving. So this is suggestive evidence that we're not seeing, at least across the spectrum, a huge amount of either reassuring or nearshoring in the United States. And if we also look at the data, China appears to still be what's called factory Asia. In fact, a lot of value chains are still focused around China. But what we're also observing is that other emerging economies like Vietnam and Indonesia in the Asia-Pacific region are now becoming hotspots for intermediate goods trade. In other words, many of these intermediate goods production is being outsourced by the Chinese to countries like Vietnam, where they put those intermediate goods together. They either assemble them into another intermediate good or even a final good, and then those go on for export. And so what we're observing in the United States, which is really rather interesting and is an indication of, in some sense, of decoupling from China, is that we're switching from directly sourcing goods from China in the United States to indirect sourcing. In other words, China's investing in Vietnam. It's also investing in plants in Mexico, often with the help of subsidies by state governments in Mexico to build plants down in Mexico. And this little graphic up here is a large industrial park in the state that borders with Texas, and that's all from Chinese foreign direct investment. So in a paper that was presented at the central bankers meeting at Jackson Hole in Wyoming last year, and this paper was heavily cited in the financial media last fall and going into the winter, suggests that what Chinese firms are doing is tariff jumping. So they invest in Vietnam, and then those products are exported onto the United States, and they enter the United States at the most favored nation tariff of about 4% that would face Vietnamese exports into the United States. But the Chinese are also investing in plants down in Mexico, and of course, if they meet the rules of origin for products produced down in Mexico under the USMCA, the United States-Mexico-Canada Free Trade Agreement, they can essentially enter the United States market tariff-free. So yes, we are no longer, or we've reduced the amount we're importing from China, largely driven by the tariffs that were implemented in 2018-19 by the previous administration to that of the current administration. But the Chinese are figuring ways around those tariffs by either investing in low-wage economies like Vietnam, or investing in North America and using the integrated market we have in North America to get their products into the United States market. And this is a graphic. This comes from the paper that I just mentioned by Alfaro and Chur, published last year. This is import market share change for the top 15 countries exporting to the United States between 2017 and 2022. So that predates the trade war and postdates the trade war. You can see that there's been a pretty significant reduction in the market share of imports coming into the United States from China. So these would be what I just called direct sourcing from China. And you can see over here, you're seeing this significant growth in imports of intermediate goods and finished goods from Vietnam, from Taiwan, and you're seeing the modest growth here. In Mexico, you're still seeing us obviously importing from other countries such as India, Canada, Korea, Ireland, Italy down here, France, Great Britain, Germany, and Japan. But you've seen a reduction over here from some of those European Union countries. So I think the bottom line, the takeaway point from this graphic is the significant decline in direct imports from China, but the Chinese are investing in Vietnam and Mexico, and so we're still indirectly importing from those countries. So now I want to start talk about trade policy. So yes, we're observing a slowdown in the rate of globalization worldwide, and to some extent a significant decoupling of the US economy from the Chinese economy in the last, certainly since 2018. So we're talking about the past 6 or 7 years. Now, what's important to also recognize is that trade policy has changed considerably over the past decade. And in particular here, I'm talking about the US-China trade war, which it was at its height over the period 2018 to 2019. And I'm going to talk a little bit about the damage that did to both US consumers of goods from China, but also what it did to exports, particularly of agricultural products from the United States to China. But we also saw the decoupling of the United Kingdom from the European Union, known as Brexit. And it's certainly the case that I saw a study the other day that suggests that UK exports to the EU, which is of course our nearest and largest market, have declined by something like 30% since we signed the trade agreement, the new trade agreement that we have with the European Union, which was signed just before the end of the Boris Johnson administration in the early 2020s. Now, this change in trade policy, there's a number of reasons for it, but it was partly a response to the import shock from China on labor markets, both here in the United States and particularly in the European Union, up to about 2008, to the beginning of the financial crisis. And I always like to cite the rate of increase of imports from China between the early 1990s and 2008 into the United States was approximately 1,400%. So a significant increase in imports from China into the United States, which had significant spatial labor market effects, both on employment and wages. And that sort of broke the social contract that we had here in the United States in terms of accepting trade liberalization and globalization. And we know from work by David Autor and his colleagues published in the American Economic Review that this has had a significant effect on voting behavior here in the United States. There's much less support for trade liberalization and globalization than there once was. And then this is a paper by some Italian economists that was published in one of the American political science journals in 2018. They were able to show that the extent of voting for Brexit in the United Kingdom was highly correlated with the extent to which those areas of the United Kingdom were impacted by imports from China. So even though Brexit was for all sorts of reasons, the data suggests that the EU was blamed for loss of jobs and unemployment in certain parts of the United Kingdom. The feeling was that was due to immigration and the European Union. But the data also suggests that many of those jobs and many of those cuts in wages were due to import competition from China. So we've had this sort of pullback, and not just here in the United States, but elsewhere in the world. And the point I'm trying to make here is that world trade and globalization, or the rate of globalization or possibly deglobalization, are likely to respond with lags to these policy changes. But we've already seen measured effects in the data, and I've already given you the example of the reduction in the United Kingdom's trade with the EU, which the United Kingdom has been unable to replace with new free trade agreements that it signed around the world with countries that it previously had those free trade agreements when it was a member of the EU. So they're sort of replacement agreements. And the United Kingdom is also a signatory to the new version of the Trans-Pacific Partnership. But it's not obvious to me, given the distances of the United Kingdom to the Asia-Pacific region, how that's going to particularly benefit UK trade. So the expectation is from trade economists and actually macroeconomists as well. Excuse me, I'm just going to take a drink of water. That additional changes in trade policy could have a very significant impact on future trade patterns and also economic growth, because economic growth is, I mean, great growth and trade are correlated. They're not, one doesn't necessarily cause the other, but they're certainly highly correlated. So now I'm going to focus mostly on current US trade policy, which I've spent a good deal of my time writing about over the past 18 months, both on my own and also with a trade lawyer friend of mine here, Dan Chow, who's a professor in the Moritz School of Law here on campus. So first of all, the 2018-19 US tariffs that the previous administration put in place, mostly against China, but there were tariffs put in place against the European Union, Mexico and Canada and other countries, particularly for goods such as steel and aluminum. Those tariffs are still in place. The Biden administration has never removed or reduced those tariffs. And if I read the political tea leaves correctly, there's clearly a potential for significant tariff increases post-election, although that will be dependent, I think, on the election outcome. Just to give you a feel for, no, I'll do that in a minute. So that's on the next slide. So at the same time, the US has turned much more to what trade economists call industrial policy. So these are targeted subsidies or other policies towards particular industries in the United States. And the clear objective there is to near or reshore parts of the value chain. And here I'm thinking of semiconductors, most importantly, the Intel plant that's planned for New Albany here in the state of Ohio. Setting up that plant generated both federal subsidies and subsidies from the state. That type of industrial policy is also being enacted in Europe, often in the same product sectors. And China, of course, is continuing to subsidize state-owned enterprises in many of these areas, not semiconductors, but certainly electric vehicles. There's also a continued focus on trade policy with an objective of preserving national security. Many of you might have seen earlier this week that the Biden administration has put a ban on Chinese-developed software in interconnected automobiles sold here in the United States. The argument is that if we have that software, it's going to be allowing the Chinese, quote, to spy on us. I can't comment any more than what I've read in the newspaper on that, but I think it's just another example of this sort of nearshoring, reshoring, and focus on national security that the current administration has been focusing on. At the same time, the US has been moving much more to a focus on regional trade dispute resolution. Interestingly, it's already used the USMCA mechanism more times than it ever did under NAFTA. There were only ever 3 cases from 1994 to 2024 that were dealt with under the NAFTA trade dispute resolution mechanism. There were kinds of problems with the NAFTA system. The USMCA system seems to have already encouraged multiple cases, 3 of which have been in agriculture, 2 related to Canada's governance or administration of their tariff rate quotas in the dairy sector, and the current one, which I'm going to talk about at the end of my presentation, in relation to Mexico's proposed ban on the import of corn that's been genetically modified. So now I want to talk a little bit about the impact of the trade war, because this is sort of a precursor to thinking about what might happen if the proposed trade policies of an incoming administration were actually to be implemented. So by 2021, the average tariffs in the US, and in brackets, the Chinese tariffs against China stroke the US. So for the US, we had on average 19.3% tariffs against China, and China had on average 21% tariffs against us. And here's the time path of those tariffs from the beginning of the trade war in January 2018. The blue line is the steadily increasing American tariffs up to January 2021. We haven't implemented any new tariffs, and that covers about 65 to 70% of imports from China. The Chinese tariffs started out on average around about 8%, and then they simply track with retaliation US tariffs up to the Chinese average. Actually, that should be 21.1%. Okay, so that's a 21.2. That's a typo on my slide there. Just to put this in perspective, in the 1930s, when the US implemented broad-ranging tariffs against imports under what was then called the Smoot-Hawley Tariff Act, the average was about 28%. So our tariffs in the United States against China have moved up, not quite to, but quite close to the kinds of tariffs we were implementing against imports, mostly from Europe, Canada, Australia, and other developed countries in the interwar period before the Second World War. What's important to understand, especially in the context of the political debate, is that these tariffs were fully passed through to buyers of imports in the United States at a cost of about 0.4% of GDP. That's about $100 billion of costs were imposed on either you and I as consumers or American firms importing intermediate goods from China. And this is the most recent study from the Peterson Institute by 2 highly respected trade economists working on a report for the Peterson Institute. Now, US agricultural exports, of all our exports to China, were disproportionately affected by China retaliating, as I've just shown you, to the tariffs that we implemented over the period 2018, 2019 through 2020. The tariff on imports of soybeans, for example, which was the product we mainly exported to China, maybe with corn and wheat to some extent, and some other products such as sorghum. But on soybean tariffs increased from about 5%, 7%, up to about 27%. And that was the biggest increase of a tariff facing US agricultural exports. And in a study, this is a peer-reviewed study by a colleague of mine, Jason Grant, who's based at Virginia Tech, along with some colleagues working for the Economic Research Service of USDA, published in one of the American Ag Econ Association's journals in 2020. They estimated that the annualized trade losses, so that would be for 2018 and 2019, the annual losses of value of agricultural exports to from the United States to China was $18.7 billion. The damage being dominated by soybean exports, where the annualized losses were $10.7 billion. USDA, the Economic Research Service, did some interesting follow-up research there, where they calculated the loss in export value that resulted from those retaliatory tariffs, and they were concentrated, perhaps not surprisingly, in the Midwest. So you can see here the different color codes are telling you that out here in, let me get my states right, this would be Iowa. I guess this would be, no, yeah, this would be, sorry, this would be Indiana, Illinois, and Iowa. And you've got Nebraska up here, Minnesota here, Ohio's over here. You can see right out there in the Midwest, we're talking about, you know, over, this is considerable losses in terms of those trade barriers that China implemented. Ohio's share of the losses, we were about the 7th largest loser from those tariffs implemented in China at about 4.7% of the total. So this is across all agricultural exports, but that would have been dominated by soybeans. If you look on the graph on the right-hand side, again, this is data from USDA, it's pretty obvious where the trade war was. We were already losing market share to Brazil, but that got exacerbated during the trade war. It picked up somewhat afterwards, after the trade war, when we had the phase 1 trade agreement with China, but we've never recouped that market share relative to Brazil in our market for soybeans in China. So now let me talk a little bit about future trade policy. So this is what we think might happen. So obviously there's an element of crystal ball gazing here, but we have to wait to see actually what happens post-election. But my colleagues in the economics profession and the agricultural economics profession and myself are paying a huge amount of attention to what's being suggested in terms of trade policy. So for example, yesterday I did an interview for Business Insider about the possibility that a 200% tariff would be levied against imports of, I guess what they're called, front loader tractors. I'm not quite sure what the technical terminology is, built by John Deere in Mexico, if John Deere were to build a plant down there. If many of you probably know that John Deere has been laying off workers in its American plants out in Illinois and Iowa, mostly because demand for machinery, particularly tractors, has been diminishing quite significantly between 2023 and this year. And they've been laying off workers, but they're also talking of building a fairly small plant down in Mexico. And I was asked about what I thought about that 200% tariff. So in terms of our trade policy, there's little chance of the US lifting its veto on appointments to the WTO's, what's called the appellate body. So for all intents and purposes, multilateral dispute resolution through the WTO is ineffective right now. In other words, it's the appellate body is not functioning. You can file a dispute, it will go to a panel, but if you don't like the panel report, you simply appeal it, and it just goes off into nowhere. Nothing gets done about it. Interestingly, there's bipartisan support in Congress for the US to discontinue what's called permanent normal trade relations with China. That's the US language for what's called the most favored nation status with China. So when China joined the WTO, China was faced with tariffs into the United States that were equivalent to the tariffs faced by all other WTO members. So under the WTO, you're not supposed to set discriminatory tariffs between WTO members. So when China entered the WTO, they were given this what's called permanent nominal trade relations, and that happened in the early 2000s. So there was a report out of Congress that said we should stop this, and there was also a bill in the Senate. I think actually Senator Vance might actually been one of the signatories to the Senate bill, along with I don't remember. I think it was a senator from either Iowa or Illinois. So there's bipartisan support for that. What level of tariffs that would generate, nobody's quite clear about. The bill hasn't passed yet, but what I'm suggesting to you is that there is actually bipartisan support to further disconnect from trade relations with China. There is a potential, and many of you would have read about this in the media. There was an article in today's New York Times about this, for an incoming administration to actually increase tariffs on all Chinese imports to 60%. And so, in other words, it wouldn't just be an increase in the tariffs on that 60 or 65% of goods that we import from China. It will be all 100% of imports we increase from China. So on that remaining 35%, you'd see a jump in the tariff by 60% and a jump in the existing tariffs by a further 40%. And there's also a proposal to impose a 10% tariff across the board on all imports from the rest of the world. So remember, on average, our tariffs against the rest of the world are about 4%, and they would rise to 10%. And there would be, I think, there would be a continued focus on targeted tariffs like the ones that the Biden administration has introduced in sectors such as electric vehicles, where I think we have a 100% tariff has been implemented, and a tariff on semiconductors. I forget what the percentage increase in that tariff is. So I would expect those tariffs to be maintained, and I would expect there to be a continued use of targeted tariffs. So there's also, not only is there talk about a 200% tariff on American firms locating in Mexico to produce agricultural equipment, there's also been talk of a 100% tariff on any automobile firms locating production down in Mexico and then exporting into the United States tariff-free. So the expectation is, depending on the election outcome, that we could see a significant increase in the extent of what trade economists would call protection of the United States manufacturing sector after November the 5th, or certainly sort of going into 2025. So what might be the potential impact? Well, the same study that I quoted earlier to you by the Peterson Institute by Clausing and Lovely. This is a great paper. I encourage all of you to read it, because it's got a number of things in there about international trade and the potential damage and harm it could do to us as consumers here in the United States. They calculate that without retaliation by China, the potential costs to US consumers of the kinds of tariffs that I've just talked about would be about 1.8% of GDP. So that would be about $500 billion per year. And something that you need to remember, and economists understand this, and the media has started to talk about it, but the political commentariat doesn't necessarily understand this, is that tariffs are actually a highly regressive tax on consumers. And they're regressive because we know from research, and this is published peer-reviewed research back in 2016 in the Quarterly Journal of Economics, is a highly cited paper that shows that not just for the United States, but around the world, that if you look at the income distribution, the main beneficiaries of lower costs due to trade liberalization are mostly those in the 65% and below parts of the income distribution. So those people on lower incomes per capita benefit more because they purchase more traded goods. Think of flat screen TVs, et cetera, But those of us on the higher end of the income distribution, here I would include myself. I think I would be in about the 90th percentile of the US income distribution. I spend an increasing proportion of my income on what are called non-traded goods. So I might go to the opera. I went to see a rock concert last week here in Columbus. I go to restaurants, et cetera. These are what we call non-traded goods. They're not things we import from China. So the argument is that if tariffs are increased by the amount that are being proposed, they are actually highly regressive. So it hurts those on lower incomes more than it hurts those on higher incomes. If China and our other trading partners were to retaliate, Oxford Economics in a report they wrote in late 2023, they're suggesting that the cumulative loss in GDP would be $1.9 trillion over the period 2024 through to 2028. So they have like a 5-year window over which they're forecasting, which when you add it up is on average, households would lose about $11,000. It's somewhat less than that if you didn't have retaliation. So it's about $5,000 to $5,500 if you don't get retaliation on average for an American household. And that's largely due to the costs that this Peterson Institute paper is talking about. If we get retaliation, that hurts the export industries, it affects GDP, it affects employment. It's likely to generate higher losses to American households. If we turn to agriculture, and China retaliated for very clear political reasons last time in agriculture, because it was targeting states in the United States, particularly in the Midwest, that would be significantly impacted by their significant increase in tariffs on soybeans, corn, wheat, sorghum exports in 2018, 2019. It's very likely they're going to retaliate again. And a colleague of mine, Sandro Steinbach, one of the best young up-and-coming trade economists here in the United States, and some of his colleagues at North Dakota State University, literally 2 weeks ago published a study that was actually highlighted in a report on FarmDoc last week, and you can see that report. And they use the World Agricultural Output Board baseline export forecast. So WASDE and USDA are involved in this baseline export, and they did an export forecast from 2025 out to 2033. If there were no change in existing trade policy, and then Steinbach and his colleagues took those data, and then they took what are called trade elasticities from the paper that I mentioned earlier that evaluated the trade war effect on US agricultural exports. They use what are called the trade elasticities. So those trade elasticities, that's jargon, but it's measuring how sensitive US exports would be to the Chinese retaliating with significant tariffs against US exports of soybeans, corn, wheat, and beef in 2025, and then they forecast out to 2033 in terms of the value of exports. And so I'm just giving you sort of the bottom line numbers here. In 2025, they're forecasting that there will be a loss of $15.8 billion worth of exports of soybeans, mostly to China, but also to some other importing countries. And that's their median estimate. That's just over 67% loss of export value. It's even higher if you look at their confidence intervals. It's even higher at the top end. It's a little bit lower at the bottom end, but it ranges from 63 to almost 70% loss in 1 year of export market value. For corn, obviously, corn, it's a little bit less at about $4.4 billion, but that's still nearly a 40% reduction in export value. Wheat, $2.5 billion, that's about a 40% reduction in export value. And for beef, it's about a $2.5 billion loss in export value just for 2025. And that's about a 25% reduction in export value for the beef sector. These graphics very quickly, these are numbers that they forecast out to 2024. So this is the most extreme scenario. That's what I've just reported. That's the Chinese and the rest of the world responding with 60% and 10% tariffs respectively against US exports. You get this significant reduction in export value. And if those tariffs remain in place out to 2023, essentially we lose a lot of export market value in soybeans, predominantly to China. They run some other scenarios where you get smaller retaliations, but you still see, depending on the increase in tariffs by the United States and the extent of retaliation, you still get pretty significant losses in market value, export market value in soybeans, in corn, in beef, and wheat. Now, what I found really interesting in this study is they also projected, I'm not quite sure, excuse what that white box is, but this is state level export loss projections for 2025 by this. As you can see, this was based on that Steinbeck et al. Study published in Farm Doc Daily a couple of weeks ago. So for 2025, the value of export losses for Ohio alone would be just over $1 billion just for 2025, about $0.17 billion for corn, a lot less obviously for beef and for wheat. And you can see that again, it's states in the Midwest, further west of us, that tend to lose the most, both in soybeans and wheat. And then when we look at beef, you get Nebraska, Kansas, and Texas coming into the story. When you look at wheat, you see North Dakota and Kansas coming into the story, as well as Montana. So the bottom line is that if China and other countries retaliate against the kind of tariffs that might be implemented post the election, the agricultural sector, as it did in the trade war, stands to lose a significant amount of export value to its overseas markets. And I'll bring that back in perspective in a minute. So very quickly, macroeconomists are jumping into the story as well. And there's likely to be a macroeconomic impact. The breadth and the size of these proposed tariff increases, if they go forward, are expected to result in a significant appreciation of the dollar. And this is a well-known macroeconomic result if you live in a world of flexible exchange rates, which we do. And if you don't have an appreciation, you're going to have excess demand for goods in the United States because of the US tariffs. And because of the US tariffs, you're going to have excess supply of goods on the world market. So in order to rebalance international relative prices, you need to have an appreciation of the dollar. But there could be additional dynamics. So if countries exporting to the United States face these increased tariffs of anywhere from 10 to 60%, then foreign central banks might cut their interest rates to help their exporters. But because that would affect their exchange rate, but that puts further upward pressure on the dollar as foreign investors add more US assets to their portfolios, because they're arbitraging the difference between US interest rates and foreign interest rates. Now, normally a currency appreciation will lower US import prices. But with most imports into the United States being invoiced in dollars, right? And if you add on tariffs on top of that, what that means is that because of those tariffs of anywhere from 10 to 60% across a range of goods having been put in place, even though they're cheaper on the world market because the US dollar has appreciated, at the same time they're invoiced in US dollars, but they also face these tariffs. And so the inflationary impact of those tariffs is likely to be exacerbated. So macroeconomists are jumping in and saying, hey, you trade economists have suggested this is going to be the effect on prices and costs in the United States, but you also need to account for the negative impact of a US currency appreciation. Now let me move into just a couple more slides on trade dispute resolution, and then I'll finish out. So prior to 2019, trade dispute resolution around the world, and for the United States in particular, was almost entirely through the WTO. And then, as I mentioned earlier, the WTO mechanism, the panel system still works, but the appeal process broke down in 2019. Essentially, the United States vetoed any new appointments to the appellate body, and it's continued to do so 78 times, and including under the Biden administration. So what are countries doing to resolve trade disputes? Well, if you look at the United States, we're either doing it bilaterally, and there I've listed the United States agreement we had with China, signed in 2020 by the Trump administration, or we're doing it regionally under something like the USMCA. Others are doing it multilaterally, and they're doing it through an acronym called the MPIA. And this is about 27 countries led by the EU. and they're using something called Article 25 of the WTO's dispute resolution rules. And under that article, countries are in a trade dispute can agree to go to arbitration through a panel, but they'll agree to accept the outcome of the panel and not take it to an appeal. And in fact, there's already been a dispute that's been resolved between the EU and Colombia, believe it or not, under frozen French fries, which Colombia lost at the panel level, and it agreed not to appeal. So there's a quasi-multilateral system under operation under the WTO, but it's more what we call plurilateral, because not all members of the WTO, including the United States, are not a party to this agreement. But I would note that not just the EU are members, but also Japan and China, which I find kind of interesting. Equally, countries like the EU are operating through their regional free trade agreements, like the CETA, which is the EU's free trade agreement with Canada. The important point to know is that these regional trade agreements do not have what's called the two-instance adjudication mechanism. In other words, there's no panel ruling followed by an appeal. Under the USMCA, if say Mexico loses a panel ruling on GM crops next month, or sorry, in November, they will not be able to appeal. Unlike the WTO, where they would be able to appeal if the panel ruling was against them. So let me just sort of pull all this together based on what I've been talking about. So let me just give you the 2024 USDA bottom line agricultural trade forecast. We're going to see an increased deficit, so that's the value of our imports is now exceeding by quite a significant amount the value of our exports. And that's largely because we've lost market share in China, and it's partially due to the fact that commodity prices have been declining, so that the value of our exports have been falling. But we're importing more of high-value products such as fruit and vegetables, particularly from Mexico. But our top two markets are going to be Mexico and Canada, so that's out of the USDA forecast. So I would suggest, given what might happen after the election, it's going to be very critical to maintain market access to both Mexico and Canada, which is why I think the GM crop dispute with Mexico is so important, both economically, and it's fundamental to what I call the credibility of the sanitary phytosanitary chapter of USMCA. So the sanitary phytosanitary chapter of USMCA relates to the use of non-tariff barriers to trade, where you might try to put in place a barrier to trade that's not based on science. And the US would argue that claiming that GM crops is unsafe has no scientific basis. And that's what the panel is investigating right now. The point about this is Mexico is the leading importer of US corn. And if they were to implement a ban, and they might not do because the incoming president has said she might back away from what the current president has said he would do, it could result in losses of about 16 billion worth of corn exports to the corn industry over a 10-year period. And that was based on a study that came out in 2022 when this GM corn import ban by Mexico was first proposed. This is just a quick graphic to show you that which states mostly export yellow corn down to Mexico. We export very little white corn. You'll notice that Ohio doesn't appear in that slide, but that's not the point. The point is if Mexico were to win this case, or were to implement a ban on genetically modified yellow corn going into Mexico, that would have spillover effects onto the North American price of corn and the world price of corn. In other words, if the panel were to rule in favor of Mexico, or Mexico refuses to follow any panel ruling against them, it would disrupt the global corn market, depressing what are already depressed corn prices, both here in the US and on the world market. The panel is expected to publish its report in November. And if the panel rules in favor of the US, which I think it will, Mexico continues with that policy, the United States can retaliate, with the potential of escalating into what would be a much broader trade conflict, I think. think about those 200% tariffs being proposed against John Deere imports from Mexico. My expectation, I'm positive on this, is that the panel will likely find against Mexico. And the precedent for this would be the 2006 WTO GM ruling against the EU's not ban on GM product imports, but they were violating some rules of the WTO. They backed off, and the WTO did actually rule against them. Importantly, compared to the WTO, though, these panel findings cannot be appealed by either party. So what I'm saying here is, if the kind of damage that we might expect, and you can disagree with the forecast results from North Dakota State University, if we were to see those kinds of losses of market share, it becomes quite critical that we continue to get access into Mexico and Canada, which is why functioning of the USMCA's trade dispute resolution mechanisms is so critical. And so with that, I wrote up part of this in an Anderson's policy bulletin. That's a link that you can find to my website. And then there's a more legal piece there on dispute resolution that I did with my colleague here at the Moritz School of Law. So a lot of information. I hope you find it interesting. Obviously, some of it's crystal ball gazing, some of it's looking back on what's actually happened. So very happy to answer any questions that have come up, Brent. Thanks so much.
Great. Thanks a lot, Ian. As usual, you're able to take an incredibly complex topic and one that's changing all the time and turn it into something that is much more understandable for all of us and into bite-sized chunks. Although you bit off a big chunk on this one today, and it's a really interesting topic. I guess, Alan had a question earlier. He kind of found the answer for it, but it raised a point in my mind that, we talk about these trade disputes or, adding tariffs and things like that here in the U.S., but is this how about the rest of the world? I mean, the Europeans doing this with China, or the Canadians doing it with China, or anyone else, right? How broadly are these kinds of trade minimizing mechanisms being used across the world outside the U.S.?
So, two answers to the question. In terms of the trade war, right, the 2018-2019 tariffs, initially the EU and Canada and Mexico all retaliated against the tariffs that were implemented by the US, not just against China, but against steel and aluminum in particular. And the EU targeted some very American products. They slapped a huge tariff on exports by the US of Harley-Davidson motorcycles, particularly to Germany. The Germans love Harleys, apparently. And they're mostly produced in Wisconsin. And that was done to try to impact the midterm elections in 2018 in Wisconsin. And they also picked whichever whiskey comes out of Kentucky. I always forget, it's bourbon, isn't it, that comes out of Kentucky. Why? Mitch McConnell, leader of the Senate, is obviously a senator from that state. So the EU was very targeted in the tariffs it used in response to the US tariffs. Subsequently, the Biden administration reached an agreement with the EU about exports of steel and aluminum to the US, and so the tariffs have been lifted. They basically negotiated what's called a tariff rate quota. Now, if I understand it correctly, the EU has implemented some very targeted tariffs against China, I think for electric vehicles and maybe on semiconductors, but not across the board like the United States has done. And nor has Mexico. Obviously, the big story there is the GM corn imports case that I was talking about. So we're seeing very little happening at the WTO. There has been a shift towards countries signing regional trade agreements, but they're not really cutting tariffs in those agreements. They're looking at things that are called behind the border, things like rules on investment. And the Trans-Pacific Partnership was very much about rules on services, intellectual property, and rules on investment, things that aren't really covered by the WTO. The Trans-Pacific Partnership in my view, the United States should have signed it because it would have given us access, particularly to Japan, and also, which has always been a very protected agricultural market. And it would have also given us access to some other countries in the Asia Pacific region. But generally, I mean, I think we've seen a step back from increased trade liberalization, hence globalization. I think is partly a function of maybe not protectionism, but less enthusiasm for freeing up trade as opposed to actually implementing new tariffs.
Yeah, we're kind of at the end of our time, but a couple things here quickly for folks. Diane Miller, our communications expert in our department, has posted details on the next webinars into the chat feature. So please have a look at that if you're interested in attending a future one of these webinars from our department. But there was one other question from Evan. If you could quickly sort of comment on it. I know we're at the end of our time here, Ian, but sort of what are the odds? The question was, what are the odds you think that Mexico continues the policy if the ruling is against them?
I think that a couple of things. Even if they were to win the case, or if they were to lose the case but carried on doing it, I don't think it's physically possible for Mexico to substitute the yellow corn imports they get from the US with corn imports from Brazil or wherever. So I think ultimately politics in Mexico will drive the outcome. The meat and livestock sector in Mexico is quite an important export sector for Mexico. They need to feed those animals. They want cheap US corn. That's what's going to drive everything. And I think the new president is going to, she's by education a scientist. And I think she's pretty much hinted she's going to back away from this, irrespective of the panel ruling. As somebody who works on trade law issues, though, to me, what's important is that the panel makes a ruling, right? And that both sides respect the ruling, because then that makes the USMCA trade dispute resolution mechanism credible. So I think this is actually very important for the credibility of future resolution of trade disputes in North America, which would involve Canada as well, potentially. Canada's not really a partner to the dispute, but it's an interested party in this dispute, because they would face lower corn prices if Mexico were allowed to continue the ban, or implement the ban, I should say.
Right. Well, that's interesting. Okay, this is great. Well, we kind of have to leave it there. Ian, this has been super interesting, as always, to hear from you on trade, globalization, and now deglobalization. Super excited you were able to join us today. Thanks for doing that. All the rest of you, thanks for visiting with us today. Really appreciate your attendance here. Feel free to have a look at the other webinars that are coming in the future. We have one a month from now through the end of the year. And then again, we'll start up in January as well. So have a look and follow that link for that. So with that, we'll call it to a close here. And thanks again, Ian.
Brent, if people haven't left, if they